On Friday, January 30th, 2026, silver didn't merely dip, it collapsed. In a single session, it fell about 31%, a move traders usually associate with failed companies, not a metal that sits at the center of global commodities markets, 50. 63, and by Monday, February 2, it was still around $77, not months, not weeks. In less than one working week, the market erased roughly $37 per ounce and rewrote what normal looks like. For years, the confident line was that modern silver markets were too deep, too liquid, too efficient for an old-school wipeout. They said the plumbing was stronger. They said risk models were smarter. They said safeguards and transparency made a crash like 1980 or 2011 impossible to repeat in the same way. And yet, it happened anyway, with the same signature you see in every leveraged unwind. A crowded trade meets a changing rule set, leverage meets margin, and the exit door shrinks exactly when everyone wants out. Here's where it gets interesting. The crash did not begin on January 30th. The worst day was simply the day the public could see the pressure finally break through the surface. The mechanics that forced that selling were being assembled long before the candle turned red. When a market falls that far or that fast, it isn't just fear, it's structure, it's collateral. It's a chain of obligations snapping in predictable places. They said this could never happen. But the system is built to do one thing when volatility explodes, raise the price of risk. And when the price of risk rises, someone has to pay. If they can't, they sell. That's not opinion, that's arithmetic. And once you see the arithmetic, the worst day stops looking like chaos and starts looking like a schedule. Welcome to the data ledger. This is where we decode what matters before it becomes headlines, and where we separate the story people repeat from the mechanism the market actually runs on. If you appreciate calm, numbers-first analysis, consider joining the community, and drop a comment with where you're listening from, because the geography of attention often tells you more than the geography of supply. Now, let's reconstruct the event with forensic detail, because the timeline is the evidence. The rally into late January wasn't subtle. Silver had been climbing, and then it turned vertical. Vertical moves are what markets do when leverage enters the room. Price doesn't just rise, it accelerates. In that phase, every dip becomes smaller, every bounce becomes faster, and the narrative becomes cleaner. Supply is tight, demand is unstoppable. The breakout is confirmed. The louder the narrative gets, the less room there is for disappointment. By the final week of January, silver drew two crowds that rarely stay peaceful together. The first crowd was conviction buyers, people focused on long-term monetary themes and the idea that metals were being repriced. The second crowd was speed, traders who wanted the next candle more than they wanted the thesis. Those crowds can coexist as long as liquidity is abundant and collateral is easy. Once liquidity tightens, they become a stampede, and stampedes don't negotiate. 87 per ounce. 9% decline using those reference points. And this wasn't a gentle reconsideration of fundamentals. Fundamentals do not change that fast. This was a violent repricing of risk and leverage, and it didn't happen in isolation. 60. When both metals roll over together after a blow-off, it points toward liquidation pressure rather than a single, neat, fundamental explanation. Liquidation has a sound. Bids thin out. Spreads widen. Stops trigger. Brokers call. Positions are reduced. Markets gap through levels that felt unthinkable 2 days earlier. The mystery isn't why sellers appeared. Sellers always appear. The mystery is why the market suddenly required selling, and why it required so much selling at the same time. To understand that, you have to step back into history, because silver's most dramatic episodes rhyme across decades. In 1980, silver's blow-off ended with a collapse that became legend. The details were unique to that era, but the mechanism was familiar. Concentrated positioning, leverage, and trading conditions that changed in real time. It broke downward as forced selling hit a thin bid. The result wasn't just a big down week, it was a regime change, a long period where volatility punished anyone who assumed the old rules still applied. In 2011, silver surged again, driven by post-crisis monetary anxiety and a powerful speculative wave. It ran toward $50 and then, within days, turned into a downward staircase. That episode featured rapid margin increases, a cascading unwind, and a narrative that arrived after the move was already underway. Again, the result wasn't a neat correction. It was a reset of positioning. The market taught the same lesson. When leverage is heavy, the path down is faster than the path up. And there's a smaller modern echo that matters too. In early 2021, a wave of retail attention highlighted how quickly silver narratives can spread and how quickly liquidity providers adjust. Even when prices don't replicate the extremes of 1980 or 2011, the lesson remains. When positioning shifts fast, the rules of participation can change just as fast. In 2026, the same structure reappeared with modern speed. First, a parabolic advance that pulled in fresh capital. Second, a risk system that began to tighten as volatility rose. Third, a repricing that looked like panic to anyone watching only the chart. But if you watch the plumbing, it looks like a stress response doing exactly what it was designed to do. So who are the players in that plumbing? Not a single villain, not a hidden hand. Systems don't need conspiracies to produce brutal outcomes. They need incentives, rules, and risk controls. The institutions involved are the ones that intermediate risk. Exchanges, clearinghouses, brokers, banks, and the funds and dealers whose balance sheets connect paper claims to collateral. A futures contract is a promise. It is a standardized bet that is marked to market every day, and that bet is backed by margin. Margin is not a fee. It is collateral, a good faith deposit that must be maintained as the position fluctuates. In COMEX silver, one standard contract represents 5,000 troy ounces. That detail matters because it turns a chart into cash. A $10 move is not just a number, it's $50,000 per contract in profit or loss. Multiply that across a book, across a firm, across the market, and the candle becomes collateral. When volatility rises, margin requirements rise, because the clearinghouse must ensure that losses can be paid even if the market gaps. This is the market's immune system. It's designed to prevent a default cascade from spreading. But the immune system has a side effect. It changes who is allowed to hold the trade. During calm periods, leverage is cheap and positions can be large relative to cash. During stress, leverage becomes expensive. If margin per contract rises, participants must either post more collateral or reduce exposure, and they must do it quickly. The market doesn't wait for explanations. It waits for money. Here's a simple way to see why that matters. One standard silver futures contract controls 5,000 ounces. At $115 an ounce, that's roughly $575,000 of exposure per contract. If required margin is in the mid-$20,000 range, the position is financed with a relatively small slice of cash compared with the notional value. That leverage can feel harmless when the market moves $1 or $2. It becomes lethal when the market moves $30. A $30 drop on one contract is about $150,000 in mark-to-market losses, and those losses are due immediately through variation margin. If the account cannot post additional collateral quickly, the broker liquidates, and the sale itself pushes price further, creating more calls. Around this episode, margin changes were repeatedly mentioned as an accelerant. Late December 2025 saw metals moving fast enough that margin hikes became part of the conversation. As volatility expanded into January, the pressure returned. Numbers discussed for silver futures margin were in the mid-$20,000 range per contract for front-month exposure. The exact figure for any specific account depends on broker add-ons and portfolio offsets, but the direction matters more than the decimal. The cost of holding leverage rose as the crowd arrived. That's how leverage gets purged at the worst possible time. Now bring in the brokerage layer. Brokers are the gatekeepers between the client and the clearinghouse. When margin requirements rise, brokers update customer requirements. Some raise them beyond the exchange minimum. If a client can't meet the new requirement, the broker reduces the position. That reduction is a sell order, not a vote. It exits because the rules demand it. Then bring in the banking and fund layer because this is where financing conditions shape the size of the crowd. When a trade becomes crowded, risk managers ask simple questions with harsh implications. How correlated are our exposures? What happens if price gaps 10% overnight? How many clients are long the same thing on leverage? What collateral are we relying on? And how liquid is it if we need it tomorrow morning? Those questions get louder when charts go vertical, because vertical charts are volatility magnets. Flows showed crowding too. In January, around $1 billion was reported to have poured into silver exchange-traded products. $1 billion isn't the whole market, but it is a loud marginal bid. It invites hedging. It invites speculative copycats. It pulls in short-term leverage that wants to amplify the move. And crowding is not just a feeling, it's a measurable state where the same trade sits in too many portfolios with too little cash behind it. Now layer in something that made this crash feel unreal to anyone watching only Western benchmarks. The physical market was not sending the same signal as the paper market. During the sell-off, reports described Shanghai trading at premiums above $14 per ounce over London benchmarks. That is a dislocation. Two markets looking at the same metal were valuing it very differently at the same time. If paper prices were collapsing because demand disappeared, why would a major physical hub be paying a double-digit premium? To make the dislocation real, imagine two clocks showing different times in the same room. They aren't lying, they're measuring different systems. Western benchmarks are dominated by paper liquidity, and paper liquidity is sensitive to funding costs, margin policy, and dealer balance sheets. A physical hub is dominated by delivery constraints and local demand. If a refiner, manufacturer, or wholesaler needs metal on schedule, the bid is not a philosophical statement, it's a procurement problem. Premiums can reflect shipping time, form factor, taxes, and the simple fact that bars are not interchangeable across every venue at every moment. This is the part no one is discussing clearly enough. The price of silver is not one thing. It is a clearing mechanism in a specific venue. Paper venues clear leverage. Physical venues clear supply. Those two can diverge under stress because the drivers are different. In a paper liquidation driven by margin, the marginal seller is not someone making a careful valuation call. The marginal seller is someone who must raise cash. The marginal buyer may step back because catching a falling knife is expensive, especially when margin is rising and liquidity is thinning. That's how paper prices can overshoot downward, even if physical demand remains. In physical markets, the marginal buyer may be an industrial user who cannot stop production, a wholesaler meeting steady retail demand, or a regional investor responding to local currency and policy conditions. Those buyers care less about intraday candles and more about getting metal when they need it. If supply is constrained locally, they pay up. Premiums rise even as paper benchmarks fall. There's another clue hidden in how paper and physical connect: the bridge trades. Dealers use exchanges of futures for physical, over-the-counter swaps and forward contracts to translate one form of exposure into another. When balance sheets are tight, that bridge narrows. Even if there is metal somewhere, the cost of financing it, insuring it, moving it, and delivering it into the right specification can rise sharply. That is when the paper price can drop faster than physical premiums can adjust, and the gap widens. Gaps like that usually close, but they can close by the high price falling, the low price rising, or both meeting in the middle after the leverage purge ends. In that window, the venue with the most forced sellers sets the headline, even while the physical market sets the real cost today. Now add reported inventories, because inventories often get used as a simple rebuttal. At the end of December 2025, London Vault data showed roughly 27,818 tons of silver held in the London system, described in bar counts in the hundreds of thousands and valued in the tens of billions of dollars. That sounds like abundance, but inventory is not the same as available supply. Metal can be allocated, pledged, tied up in financing, earmarked for specific holders, or simply not offered at the price a distressed buyer is willing to pay. A warehouse can be full while the market still feels tight at the margin. It also helps to remember that the silver ecosystem is layered. Vault totals can include metal that is privately owned, metal pledged as collateral, and metal simply stored but not offered. Even within exchange-linked inventories, categories matter. Some metal may meet specifications yet remain eligible rather than committed for delivery, while other metal is specifically registered for delivery. Those distinctions are easy to ignore in a headline number, but they matter when a stressed market is trying to source deliverable supply on short notice. This is why a market can look well stocked in a report and still behave like it is tight when stress hits. Stress tests the same questions every time. Who can deliver, who can finance delivery, and who can survive the collateral cycle long enough to do it? And this is where the dislocation becomes more than a curiosity. If one region is paying materially more for physical metal than another, the incentive is to move supply toward the higher price. But moving supply is not instant. It requires inventory that is actually for sale, logistics that can be arranged, and financing that can survive a volatile window. In a calm market, arbitrage is straightforward. In a stressed market, arbitrage is a minefield because prices can move faster than cargo. So let's make the mechanism simple without dumbing it down. Picture a crowded theater. When the show ends normally, people leave in waves. The exits are wide enough, the crowd is calm, and the flow works. Now imagine that, while the audience is still seated, the manager announces that some exits will be narrowed and that anyone lingering in the aisle will be penalized. That is a margin hike. People who were comfortable suddenly realize they're out of compliance. They rush to fix it at the same time. In market terms, when margin rises, leveraged holders must add collateral or reduce exposure. Many reduce because adding collateral is slow, expensive, or restricted by risk limits. When many reduce at once, selling pushes price down. As price falls, mark-to-market losses appear, and those losses consume more collateral. Now, even participants who could meet the new margin face additional calls because their positions are losing money. That produces more forced selling. The loop tightens, and the loop has no sympathy. This is why the worst day can look sudden. The system tolerates crowding until volatility hits a threshold. Then it raises the price of risk, and the crowd can't pay. The day the crowd can't pay becomes the day everyone remembers. Now we can return to the claim that the worst day was planned long before it happened. Planned not as a secret plot, but as a set of automatic responses embedded in risk policy. The moment volatility expanded, the responses were already in the manual. Margin up, collateral rules tighter, exposures reduced. Once that sequence begins, the outcome becomes less about debate and more about math. So what does this mean going forward? Not a prediction, a framework. Historically, after a forced deleveraging event in silver, one of three paths tends to follow. The conservative path is stabilization through exhaustion. Selling slows because the weak hands are gone. Volatility cools. The market forms a base. Physical demand absorbs what it can, and paper positioning resets. Prices can remain depressed for a time because trust takes longer to rebuild than excitement. The moderate path is a rebound driven by dislocation closure. If physical premiums stay elevated and logistical flows begin moving metal toward the higher-priced region, paper benchmarks can recover as the market recognizes liquidation was the driver, not a sudden disappearance of end demand. Volatility remains high, but the free fall ends. The aggressive path is a renewed squeeze dynamic. If physical tightness persists while paper positioning becomes cautious, any new wave of demand can meet a reduced willingness to short. That can create another sharp move, but it usually needs a catalyst, a visible draw in deliverable supply, a change in financing conditions, or a broader shift in risk appetite. What should be watched now are the indicators that reflect the system, not the noise. Watch margin policy and volatility. When margin stops rising, forced selling pressure often eases. Watch flows into and out of exchange-traded products. Heavy outflows can extend liquidation. Renewed inflows can signal returning appetite. Watch cross-market premiums between major physical hubs and paper benchmarks. Persistent premiums are the physical market waving a flag that paper may be ignoring. Watch how futures spreads behave. When your months trade unusually strong or weak relative to later months, it can hint at immediate tightness or immediate stress. Watch delivery activity and changes in what market participants consider deliverable. Watch open interest relative to price. When open interest collapses alongside price, it often signals leverage being purged. When price stabilizes and open interest begins to rebuild, it can signal a different phase. And watch the relationship between gold and silver. In a pure silver story, they can diverge. In a collateral story, they often move together because the same risk reduction hits both. The sharp gold drawdown alongside silver is a clue that liquidity and leverage were central to the event. There's a divide that emerges after episodes like this. It is not the divide between bulls and bears. It is the divide between people who track stories and people who track systems. People who track stories will argue about why silver should be higher or lower. They will debate mine supply, industrial demand, and long-term monetary themes. Those things matter over time, but they do not explain a 31% one-day drop. People who track systems watch collateral, positioning, margin, and dislocations. They recognize that markets can be right in the long term and still be ruthless in the short term, because the short term is where leverage gets punished. This isn't about being smarter. It's about watching the levers that move price when stress arrives. Institutions often move first because their mandates force them to. A clearinghouse does not wait for a headline. A broker does not wait for a narrative. A risk manager does not wait for a viral thread. They act because their survival depends on it. Retail often moves last because retail trades the chart, and the chart is a record of what already happened. That timing gap is not just a knowledge gap, it becomes a wealth gap. If you take one lesson from January 2026, let it be this. In a leveraged market, the most important data is not the story you want to be true, but the constraint that can force you to act. Silver's worst day looked like chaos. Underneath, it looked like a system doing what systems always do when volatility explodes, raising the price of risk until the crowd can no longer pay it. This is the data ledger, where we decode what matters before it's a headline. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether markets will produce another impossible day. The question is whether you'll recognize the setup before the candle prints.